Thanks for clicking! Canada's inflation rate came in as expected this morning at 1.7%, led in large part by a major decrease in gas prices.
We're in the clear.
Well, yeah, but the measures of core inflation, those measures the Bank of Canada looks to when deciding on interest rate policy, came in hotter than the Bank of Canada would like to see. The bank isn't going to be happy about core measures in that 3% range, especially as Canada's economy continues to show signs of weakness. But I think of greater concern to the central bank is going to be the inflation/economic reports coming out of the United States, with a number of recent reports noting that not only is stagflation starting to take shape in the US, but also that we're all going to feel the brunt of those pressures.
We're all
So what I want to do today is go over Canada's inflation data for the month of July, take a look at these pressures coming out of the United States and how they could affect us here in Canada, and then go over some implications. The next big piece of data that's going to be influenced the Bank of Canada's rate decision in September is the unemployment rate, set to be released in a few weeks. We'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into this inflation data. Onto the data. As mentioned, Canada's inflation rate in July came in at 1.7%, led in large part by decreases in gas prices. Absent those decreases, inflation would have been 2.5%. Major upward contributors to the month-over-month price increases included air transportation, telephone rent, travel tours, and natural gas, while women's clothing, gas, cars, children's clothing, and clothing accessories pulled prices down.
It's go time.
But as has been the case for the past few months, measures of core inflation, those measures the Bank of Canada cares about, remained sticky, with CPI median rising from 3.0 to 3.1 and CPI trim remaining at 3.0. We are seeing some downward pressure month over month in those core measures of inflation, but still probably a bit too sticky for the Bank of Canada's liking, as argued by the Conference Board of Canada.
At the core inflation numbers, or the numbers excluding energy, for example, you're still seeing inflation stubbornly high.
So inflation coming in at 1.7%, but core measures of inflation still over that 3% range, probably too hot for the Bank of Canada. Absent a major downward read in unemployment in September, the bank will likely be holding at its September announcement. But that's all just domestically. What about these growing stagflationary reports coming out of the United States? First off, just very briefly, as we're all well aware, when we're talking stagflation, we mean slowing economic growth amid rising inflation. It presents a real problem for the central banks, as if they lower rates to stimulate economic growth, they're going to see more inflation. On the other hand, if they raise rates, they're going to put even more upward pressure on unemployment. We've seen two big bouts of it, one in the 1970s and one in the early 1980s, when unemployment and inflation both spiked. And we're starting to see the beginning stages of this coming out of the United States, with the Producer Price Index, that is, the prices that wholesalers pay, coming in much hotter than expected, while the US economy is also performing much weaker than many had thought. Which makes sense. Companies up until recent had been eating the cost of these higher tariffs, but are now passing them on, sending prices upward. Meanwhile, tariff uncertainty, supply chain issues, tariff retaliation, etc., has companies hiring less. So prices are heading upward in the States, the economy is on a downward trend, basically exactly what almost everyone thought was going to happen since all of this started back in December.
Boom, out of left field.
This was all pretty much expected, as tariffs are in fact a tax, and when you introduce a tax, it both sends prices upward and puts downward pressure on the economy, which is why governments are hesitant to introduce more taxes. If there were no consequences for tax increases, the US wouldn't be $37 trillion in debt.
Whoa!
So we're seeing evidence of stagflationary pressures coming out of the United States, with a recent survey completed by the Bank of America finding that 70% of global investors said to expect more of it. So, as the 95-dimensional Grand Chess Master himself tries to reshore US manufacturing by sending prices upward, prices are increasing.
Whoa!
And Harvard's price tracker shows that this is very much happening across both domestic and imported goods, moving up over the past few months. And one of the biggest worries, for the rest of us at least, not the biggest, but we'll get there, is that these tariff increases, these stagflationary pressures, could pummel bonds, meaning higher bond yields, meaning higher interest rates, higher cost of borrowing, not just for the United States, but for all countries across the G7, Canada included. And we can already see those stagflationary consequences at work in the bond market. When the United States had that big jobs revision earlier on in the month, we saw bond yields plummet, but then pop back up on that PPI data and subsequent inflationary concerns. And of course, the yield on the Government of Canada bonds, which dictate fixed mortgage rates for both you and I, as they always do, moved up in tandem with the yield on the 10-year Treasury. So, U.S. price increases are pushing up borrowing costs, a real problem for the Federal Reserve, as the economy is showing signs of weakening already. And as we all know, when the U.S. economy sneezes, Canada catches a cold. So higher borrowing costs, a slowing economy in the United States, one way or the other, will lead to higher borrowing costs and a slow economy here in Canada. But the real problem, the biggest problem, could come if the Federal Reserve caves to the pressure by President Trump to cut interest rates, as we saw with Fed Chair Arthur Burns in the 1970s. Burns, the Fed Chair from 1970 to 1978, prematurely cut interest rates in the mid-1970s, even as inflation was running at elevated levels, setting the stage for the inflation and the interest rates, of which we're all well aware occurred in the 1980s. And it wasn't just floating rates, it was fixed rates as well. After Burns slashed rates mid-1970s, short-term rates came down, but yields remained flat, eventually skyrocketing to account for that higher inflation.
You got a good life. A good life.
The lesson learned from that premature cut, as argued by the Financial Times, was that letting inflation run rampant and allowing long-term inflation expectations to rise is more poisonous to growth than a one-time crash. Meaning, even if we see a recession or job loss, it's much more painful to let inflation run rampant. That was a lesson that we all knew for about 5 decades, and now we're in Nutso Town, with Treasury Secretary Bessent arguing that the Fed should cut rates by 150 basis points amid rising prices.
Did I do good? Did I?
And amid those comments, there is a growing concern that Trump is shifting the Federal Reserve, with his latest appointment, Stephen Moran, being pro-tariff and pro-rate cut. We've got Fed officials breaking ranks with Chair Powell in order to garner favor with the U.S. president, and the president has already been explicit that he won't be appointing anyone to the Fed that doesn't support interest rate cuts. All of this occurring in the background of intentional price increases. So we've got these stagflationary pressures coming out of the United States in conjunction with rising concerns that the Federal Reserve is going to repeat the mistakes made in the mid-1970s, bowing to political pressure and prematurely cutting interest rates amid rising prices. So yeah, current U.S. inflationary pressures already pushing up borrowing costs here in Canada, but the real concern is that the Federal Reserve could repeat the mistakes made in the 1970s, bowing to political pressure and cutting interest rates amid rising prices. Today's inflation report, not overly exciting, not overly worrisome either. Core measures remaining sticky, probably leading the Bank of Canada to remain in a holding pattern. But as we've been talking about on this channel for the past few years, and has always been the case, the United States is where we should be looking. If we want to know where borrowing cost is heading, watch the Federal Reserve, watch how this drama is playing out between Trump and the central bank. Fed Chair Powell is set to speak at Jackson Hole on Friday, and we might be getting a better idea if the Fed, in the immediate term, is going to be bowing to that political pressure. We will obviously continue to track events emanating out of the United States and their impact on us here in Canada on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.